So welcome everyone to this fireside chat featuring Anthony Scaramucci, founder and managing partner of SkyBridge Capital, and David Bahnsen, founder, managing partner and chief investment officer of the Bahnsen Group. My name is Rachel Pether and I'm a senior advisor with SkyBridge based in Abu Dhabi in the Middle East. Now, we have attendees from all over the world today, so good evening to our attendees in the Middle East and Europe. Good afternoon to those of you on the East Coast of America, and good morning to everyone else in America. First and foremost, we hope that you and your families are healthy and safe during these times. And we also really appreciate you taking the time to attend today's webinar, because even though a lot of us, or most of us, are working remotely, we know that there are still lots of demands on our time. Just in case our speakers today are not familiar to you, we have Anthony Scaramucci, who is founder and managing partner of SkyBridge Capital. He is the author of 4 books. He's a graduate of Harvard and Tufts, and he served as the White House Communications Director back in 2017. We also have David Bahnsen, who's the founder, managing partner, and chief investment officer of the Bahnsen Group, which is a private wealth manager. He's frequently named as one of America's top financial advisors by Barron's, Forbes, and the FT, and he is also a published author. Now, we want to keep this as interactive as possible, so we will be taking questions from the audience. I'm sure many of you by now are familiar, if not overly familiar, with Zoom, but you can post your questions in the Q&A section at the bottom of your screen. So the format today will be Anthony and David will have an open and casual dialogue between themselves, and then for about the last 20 minutes, we will be opening up to your questions. So on that, over to Anthony and David.
Thank you very much for the setup, and I'm really looking forward to the conversation. It's been a whirlwind for all of us, and obviously the folks in the hedge fund community, alternative investment community have not been immune, and that's why Anthony asked me to host this call with him today. So we're going to focus most of our efforts particularly around SkyBridge, their outlook, things happening within the firm. My firm is an investor in SkyBridge. I've personally and with client capital been invested in the fund since the financial crisis, going back to the days where it was lifted. Smith Barney came into Morgan Stanley, and so Anthony and I go way back in that regard, and I have a lot of fondness for the team and for the investment approach at SkyBridge over the years. And through these tough times, I think this conversation will be fruitful to clients and advisors and the like. Anthony, let me start off with a kind of general question before we really get into nitty gritty with SkyBridge. Just from a broader standpoint with the economy, the markets, we've seen this really sort of extraordinary recovery in equity markets from the March 23rd lows. We've seen credit spreads tighten to some degree. It's certainly a very different feeling right now than it was in capital markets at the peak of the hysteria, that third week of March. But a good portion of the economy is still shut down, and we know that there is tremendous tensions in the labor market, and GDP contraction for Q2 is going to be depression-like horrific. What's your overall outlook and feeling right now about where we're headed, just in a macroeconomic sense?
Well, first of all, thanks, David, and thank you, Rachel. Listen, I mean, we're going to go into a rough period of time. Everybody knows that. I think the equity markets are sort of casting light into the end of 2021 into 2022 and recognizing that there is a high likelihood that there'll be a fairly steep recovery on that side. So, you know, is it a U? It depends on how you want to describe things. A V would, I think people would be thinking we're recovering in the third or fourth quarter of this coming year. I think that's sort of unlikely, but closer to a V or an intermediate between a V and a U is a first or second quarter 2020 GDP print that is close to the 2019 fourth quarter. And so, David, I do think that that will happen. And let me just give 3 quick reasons why. Number one, we have an overwhelming amount of stimulus. And some of you have heard my calls before. The $2.7 trillion stimulus, you're good friends with Larry Kudlow. There's about $500 billion baked into the $2.7 trillion coming from the Congress that's going to get levered 8-to-1. And I can send to everybody that has an interest the New York Times article from last month that describes that leverage component. It kicks the fiscal side of the stimulus into about a $6.7 trillion stimulus. On the Federal Reserve side, I think this is what's really powering up the equity market right now. The Federal Reserve has already deployed $2 trillion into the marketplace. As an example, going back to the 2008 crisis, they deployed about $1.5 trillion over 18 months. They've put $2 trillion in the first 8 weeks. They're on their way to $4 trillion. They likely get there in the next 15 months. They were pacing at $331 billion a week from the third week in March. They've slowed it down now to about $100 billion a week, but the magnitude of that is enormous. And that's why it showed up first in the equity markets. Everybody on this call right now is an experienced investor. You know that the fixed income markets will lag the equity markets, particularly the more esoteric, more difficult things to understand, like structured credit. And so we're having a lagging effect there right now. But what I would implore people to look at is the integrity of these cash flows. The price for the apocalypse in late March, I think the data is now coming in to suggest that that apocalypse is not going to happen for mortgages, not going to happen in terms of delinquencies and forbearance, as a result of which those credit spreads will eventually tighten. And when they do, you and I know there'll be a tremendous amount of opportunity there.
So Anthony, before we dig into some of the recovery aspirations and the catalyst that you're anticipating towards those conditions improving, do you mind if we start with what it is that did deteriorate specific to SkyBridge? So I imagine most listeners know of what took place during that peak hysteria, spreads blowing out, unbelievable dislocations in the market, tremendous forced selling. I called it with our clients a national margin call. You guys got caught up in that. How did it impact performance so severely when your equity beta was so low?
You know, and I think that was the signal of reinforcement was, frankly, the 2018 fourth quarter drawdown, David. You know, the market went down, I guess, in about 15 to 16 weeks, 17 or 18%. We held our gains in 2018. We were up 3.5 or 3.25 when the market was down 4.5. And so we were fortified that our strategy was offering a low beta result. Moreover, in January and February, we were plus 65 basis points. When we got to mid-March, our mid-March flash report was down 4.7%. And I think the market at that time was down about 27. So when we were going into that weekend, the 14th and the 15th, we were pretty comfortable, although we were worried that the equity markets had let us in and the fixed income markets were lagging. And then something seismic happened on the morning of March 16th. It was a combination of different things, but the first thing was the repo desks at the nation's banks went out to the mortgage REITs, went out to the mortgage hedge funds, anybody owning structured credit in a leverage format, and said, okay, listen, we're marking those bonds down. Yes, I know they didn't trade to these levels last week, but we're going to take them down respectively 5, 10, or 15 points. And oh, by the way, you now need cash at our repo desk. We are not going to take in-kind securities or unencumbered securities at the repo desk anymore. We need cash. And so that is a sort of weird, quirky thing there, because that didn't happen in 2008. It didn't happen in 1998 during the long-term capital management crisis. But in a post-global financial crisis, banking environment with very tight regulation, they made that move, and it touched off a cascade of selling. And you may recall, my friend Tom Barrack on CNBC that week explaining that those shifts in margin were going to cause an unnecessary collapse in the mortgage space. And so that happened. Structured credit funds went down anywhere from 40 to 70%. In the case of Angelo Gordon's mortgage REIT, it got taken out. It went down 100%, and they went into a lawsuit with RBC to try to get their portfolio back, basically saying, these margin call changes. We're moving the goalposts midstream. Unfortunately, they didn't get the suit in on time, and so they weren't able to get the injunction to stop the selling, large-scale selling of their portfolio. There's no excuse for any of this, by the way. I'm fully accountable. The investment management team at SkyBridge is fully accountable. In hindsight, we had too much structured credit in the portfolio. We love structured credit. We're long-term thinkers. There's a great adage that I often repeat to people. Everybody is a long-term investor until they have short-term losses. The minute they have short-term losses, as you know, they pick up and they call Bahnsen and they say, hey, get me into cash. Okay. And that's what they're sort of doing in a mass panic. But if you sit down and you actually look at the tranches of securities that we own, and you look at the integrity of those cash flows, you would be greatly comforted by that. I used an example with one of my clients yesterday, someone who added money into our portfolio in April, added again in May, the following sort of analogy. Say we were in a building together. We had very affluent tenants in that building. They had some skin in the game with us. If they stopped paying their rents every month, they would lose that piece of equity, and they would obviously lose their residence. And so they're affluent people. They're primarily white collar. They can work at home or work remotely, as you and I have been doing. Are they going to give up their home? Are they going to sell a home that's their primary residence? Is he or she going to walk away from that knowing they have a lot of equity in the house? And will they go into forbearance or defeasance? And so lo and behold, the risks and the unknowns in the third week of March, the market was pricing that. But what it really was pricing was a technical overselling to meet margin calls. And now fundamentals, looking at them 5-6 weeks later, the injection of Fed liquidity, the stimulus package, the recognition that Armageddon scenario as it relates to forbearance and delinquencies is not happening. We are seeing that slow improvement in credit markets. But you and I both know we're doing this a long time. For myself, it's my 31st year. It will take a while for this to normalize. I'll take people back to SkyBridge Series G, 2008. We were down 19.5%. We lagged on the way up. The first quarter of 2009, we were up 3%. And then over the subsequent 21 months, we had a 35% return. And so if you stayed with us, you didn't get juked out of the portfolio due to those pricing pressures and those mark-to-market pressures, and you understood the way good credit analysts do on the SkyBridge portfolio management team, if you understood the integrity of those cash flows, you knew once credit markets started to normalize, those spreads would come back in to where they trade in a more normal credit market. Now, one last point. Look at a 120-year analysis of credit markets. 15% of the time they're in breach. 85% of the time they trade in a liquid manner. And it's incumbent upon us as professionals to coach our clients to stay patient when they're in breach, because as the cash flow's there, it will show up in principal value, and we predict that will happen.
So, Anthony, in my analysis so far, the things that really resulted in the peak of forced selling in late March, primarily out of the hedge fund community, were in no particular order: structured credit, risk parity blowing up, and dollar shortages that were affecting emerging markets debt. Is the only one of those three categories that really hit SkyBridge, the structured credit, or were you hit by the sort of $400 billion blow up in risk parity as well?
So we weren't hit specifically by that, but this, you know, and I know that we're all got hit by that sort of stuff. And so anything that's happening tangentially around you, unfortunately in a crisis, is affecting your portfolio. You know, one of the unspoken truths about our business, and this is my 31-year observation, and as you know, I started as an FA. I built an RIA that I eventually sold to Neuberger Berman before I started SkyBridge. And so I've worked as a financial advisor and through that lens. We're all searching for that holy grail. We're searching for that product that has pure non-correlation to the other products, and we're trying to fit it into our clients' portfolios. So when we get that wave, we get that, you and I know the 10,000-year flood happens every 5 to 10 years on Wall Street. When we get that hit, we know that the correlations for some reason all magically go back to one. And so whether it was risk parity, structured credit, the things happening around us, they had a deep impact on SkyBridge. But specific to your question, it was really the structured credit thing that zonked us in March. Now, the good news is we hived off stuff that we didn't like. We have to look at the world not the way we want it to be or the way we think it should be. We have to look at the world the way it is. Our world from February 28, 2020 is long gone, David. We've had a decade pass in the last 2 months, and we have to look at the world now in a post-COVID-19 environment. What is the world going to look like? How is it going to shape up? And where are the opportunities to make money? So we've stayed in our discipline. We're a concentrated group of people. We've been doing this together for 15 years. And so we're going to hold a lot of that structured credit going forward, but we're going to hold less of it in areas that we think are going to recover more slowly. So this would include things like the community banking area, the trust preferred securities that you and I have talked about, which I'm happy to explain to the extent you want me to, and some areas and levels of commercial real estate. One area of commercial real estate that we're probably more troubled by than other areas is suburban retail and suburban commercial real estate. And that does have a big effect on community banks because a lot of these community banks, David, they hold their loans from those developers or those landlords on their balance sheets. And if you have a lot of high vacancies in mixed use buildings and things like that, that could put pressure in that area. And I'm not saying it's long-term bad, but it will take a longer period of time for those asset prices to recover.
So when you talk about the integrity of the cash flows and investors being able to be encouraged by the fact that most of these things had mark-to-market distress, they're still performing. You look at the RMBS, the non-agency, you had a lot of exposure there. It's still cash flowing. Spreads are tightening, but not that much yet. I've heard a lot of people on Wall Street say that they're waiting for capital formation, that there's going to be entities. You mentioned even Angelo Gordon is one of them. Some of these groups come together, form special purpose vehicles to buy some of this. You get capital back into the market. Is this a 2-month story, a 6-month story? Assuming no further action from the Fed and assuming a path of economic recovery that is good but not overly optimistic, what is your view on seeing that recovery into these cash flow performative credit assets?
Well, listen, you could get a marginal benefit in 2 months, but I sort of see this over 9 to 12 months. If you pace back to the 2008 crisis, things started moving 6 to 9 months after the crisis was over. I'm going to stipulate for the purposes of our conversation that March 23rd was the low. I think there's a lot of evidence to support that, primarily because the induction of all this liquidity by the Fed into the marketplace. And so if you were studying that trading day, which of course I was sitting in my home, you were watching the VIX go from 88, 89 to 44. It was a 50% cut of the VIX in about a 2.5 hour period of time. So when you're talking about a national margin call, that's your national margin call, David. That's where there was full-blown capitulation. All loose holders of stocks or bonds were shaken loose from the market there. And then we saw the ride back up very quickly in the equity markets, but it is lagging in the bond market. So to me, is it 9 to 12 months? That seems more reasonable. I can't honestly predict when it's going to happen, but one thing I know that holds true, this is the 9th crisis I've seen in 31 years, is the Warren Buffett aphorism that the market is the most efficient vehicle for transferring wealth and value from impatient people to patient people. And so we're experienced guys, you and I. We try to coach our clients to stay in the game with us and to stay disciplined, particularly in periods of crisis. To go back to that building that we own together, the cash flow is coming in. The people have ownership in that building to continue to pay that cash flow. And yet, let's say we have to sell it right now. Well, you know what? We're going to get 20% less for that building because we're in the global pandemic. 2/3 of our economy in the U.S. is shut down. 4 billion people that live in the northern hemisphere of planet Earth are impacted by the crisis. So if we've got to sell right here, right now, we're going to get a sloppy bid side price for this sort of stuff. But we know that integrity of cash flow is good. If you and I did a dividend discounted model and we did a forward cash flow stream and worked it back to a net present value, I think we own something right now at 80 cents is probably worth $1.05 or $1.10. And I'm trying to encourage clients to just hang in there. And frankly, I would tell clients that this is a huge buying opportunity, particularly for SkyBridge, because we have high watermarks in most of those funds. This is a very cheap structured credit vehicle right now. So you mentioned guys setting up SPVs, Dan Loeb setting up one, Angela Gordon perhaps will set up one. You can get access to this stuff at a very low price through SkyBridge right now. And so that's why I'm increasingly optimistic as each day goes by. First of all, I haven't been thrown out of my house and my wife hasn't filed for divorce, so I'm super happy about that. And then secondarily, I'm looking at the market and I'm looking at the opportunity, and I'm seeing a great opportunity for all of us.
Well, and so I think you've sort of implicitly answered what my next question was going to be. It's obviously something you and I have talked about a lot offline, but I think it'd be helpful for listeners to hear. That paper that, for sake of argument, is at 80 cents, that we believe fair value will prove to be something over par value. You still own that paper. There's still exposure to that paper. You have not, for the most part, had to get blown out of it from redemptions and margin calls. It's a mark-to-market loss, and you still see an accretion to full value.
Yeah, that's a very good point. And so, as of right at this moment, yes, we do have a couple slides. We could probably put those slides up at this point. We have made a shift, and so this is my point about we want to hold fast to our principles and our investment discipline, but at the same time, we want to look to the future. And you can see from the slide that's up there right now that we are making some shifts. And so we've reduced our structured credit exposure, basically shedding what we were talking about, shedding the Trump securities, shedding some of the community banking exposure, some of that suburban commercial mortgage-backed exposure. And we've shifted now into places like Bridgewater, where I think the Bridgewater Fund, the Pure Alpha Fund, the 18 vol fund there, David, that's been closed since 2007. No one's had access to that for the last 13 years. I think we have a huge opportunity in that fund because nobody understands the money supply or the quantitative easing strategy of the Fed better than Ray Dalio and his team. And you and I both know that we're now heading for QE infinity. And so with that in mind, we've made that shift. 0.72, you can see that's going to be one of our largest holdings now. Steve Cohen is a very close personal friend of mine. I asked for a $250 million slot of allocation from him, which he has given us. If you go down the list there, you've got Canyon, big distress fund, put about $200 million there, $100 million with Howard Marks and Bruce Karsh, Renaissance with James Simons. And so what we tried to do is we shed the stuff that we thought was not going to work. We kept in an unrealized loss a very large amount of that inventory that we think is underpriced. But we moved into what I think are some of the best known names in the industry. All names, Josh Brown mentioned last Friday when I was on CNBC, but some of those names haven't done well recently. Well, that's true. They were concerned about the equity markets recently. But go back and look at the names that we've added to our portfolio coming out of the global financial crisis in 2009, 10, and 11. Those names on that slide right there had explosive returns. And so for us, we're staying with the theme and the concentration in structured credit. 52% of our stuff's going to be there. But we shifted into these other managers that we think are going to play the distress cycle, play the quantitative easing cycle. Someone like Steve Cohen has a very sharp eye on equity exposures and when to get long, but also has the dexterity, if things are not going well, to get flat in a hurry. And so I'm super excited about the forward trajectory of the portfolio. And as you and I both know, high net worth individuals oftentimes can't get access to names like that, in particular Ray Dalio, who has a $500 million minimum. We're able to access that for our clients post-COVID-19. And so we basically have taken an offensive measure at SkyBridge. I want people to know that are investors of ours or thinking about investing with us now that we're operating on offense and we have a high degree of conviction about the portfolio. And we think we're going to have those 2009, 10, and 11 sort of returns.
And you mentioned before, Anthony, that coming out of the first quarter of '09, and that's the point at which I became an investor with you, that you ended up over the next 2 years growing at 31% net. And of course,
it was 39. It was actually 21 in 2000 and 21 and a half in 2009. I think 18 and a half in 2010.
And so in that period of time, I would point out that of course, equity markets were recovering as well, but it isn't like that was happening without volatility. 2010 had the flash crash. It had the beginning of Greek debt issues. There was plenty of vol in 2010. And you not only grew at 39% then, but you were doing it with about a third, maybe a fourth standard deviation. Do you see the offense you're taking on now, being able to play recovery and play QE still in a lower vol environment?
Yeah, I think so. I think we'll have a way lower vol than the overall market and a way lower vol than a specific security structure. You know, we've typically had a lower vol. We had an aberration in our volatility in March because literally if you and I went to the laboratory and I said, okay, David, we need to concoct something that's going to really hurt our portfolio, at least from a mark-to-market basis. And the thing a meteor strike wouldn't have done it. A cyber attack wouldn't have done it. But a global pandemic that shut down 2/3 of the U.S. economy and disrupted 4 billion people, well, for structured credit and mortgages, that would do it because people would get scared and they would think that a lot of those tranches, people are either going to forego their rent or forego their mortgages. And, you know, then you have the concomitant thing that happened in the banks. The banks have gotten way more conservative, which actually, you know, the double-edged sword. They got way more conservative, so they cut their margin risk back with the mortgage REITs. But that conservatism has left the banks in pretty good shape going forward. I think the banks are going to play a very large role in the recovery. I just want to point out to everybody the SkyBridge analysis on PPP. If you go to the treasury.gov website, there's about 41 million people that are affected by the $900 or so billion of PPP, the payroll protection plan. About 17 million of those people are unemployed right now. And so when the switch gets flipped on in the economy and PPP is energized, you're going to see a very precipitous drop in unemployment. And so when that happens, that will sort of cure some of the risks associated with mortgage delinquencies and forbearance and that sort of thing. You and I both know that the market likes positive delta. And as that positive delta starts to happen, you'll see that price performance improve.
So with 52% targeted to keep in structured credit, you're still up there higher now, shedding some of the things you think are more vulnerable, but that non-agency RMBS is an area that you see as being pretty solid and you're keeping a lot of that exposure.
Yes.
It seems to me that record number of new mortgage apps still coming through in this period. The new purchase mortgage apps this last week were 1% less than they were a year ago at this time, which is just stunning. All the indications are that residential mortgage market looks very healthy. There's a lot of equity in homes, categorically different from 2008, even though this sector got priced for 2008. So is the residential theme something you feel differently about versus the commercial theme?
Yeah, no question. I mean, so you're giving the stats better than I can give them, but just think about this. There was household savings rates went up dramatically after 2008. Many people are rethinking their footprints now post-COVID-19. Some people are going to work more remotely. People want to get out of the city. You see waves of housing demand out in the Hamptons or in Connecticut or parts of New Jersey, here in the tri-state metropolitan area. I think that's true around the country. And so, yes, you're getting that demand pickup. You've had a sort of drop in supply, which I think will squeeze those prices as well, which will make that market even more robust. So, yeah, no, we're super confident in there. You know, when we talk about the 52% in structured credit, that's sort of like fund managers dedicated to structured credit. But I just want to point out, Dan Loeb in the Ultra Fund, which is juicier fund, it's his more geared fund, He's got a ton of structured credit in that fund. Other managers in those categories in that slide have pieces of structured credit in their fund. So this is still a pretty big bet on structured credit. It says 52 on that slide, but if you bake in the multi-strats that own it, you could be as high as 60%. And to me, I think that's where we want to be. That gives us that return capacity and that strength to recover. But think about where we'll be. We'll be in distress. We'll be in a quantitative easing, betting the easing of the Fed through Bridgewater. And obviously, we'll have the equity exposure through places like Renaissance and places like Point 72. So when I step back now and I look at that portfolio, I love that portfolio. I was very excited to be able to take advantage of the crisis as well. The crisis was terrible for the month of March, but if you think about the markets the way I do, and I know the way you do, that those are prices that are for right now. Those aren't the long-term prices. The market is a voting machine in the short term. People vote with their feet when they hear pandemic, but it's actually a weighing machine over long periods of time where it will weigh the fundamentals. So I'm sitting here looking at a portfolio, in our opinion, that's priced intrinsically at a 25 to 30% discount. And if you take a snapshot of the entire portfolio, the portfolio is yielding about 11%. You know, Josh Friedman's portfolio that we bought into in April, if you look through his letters, he has a 20% aggregate yield on his distressed portfolio. You bake that into the weighted average of what we own, we've got an 11% yield. You're clipping off a 90 basis point coupon a month in our portfolio, waiting for a graduation in equity and bond prices.
And we haven't talked a ton about the Fed, but maybe I'll ask you one question there and we'll move on to more SkyBridge specific. How much of your outlook and the way SkyBridge is positioning right now requires more support from the Fed to capital markets as opposed to, or is it more lined up with the support we already know is coming, the QEs, the post-2008 playbook with TALF and now TALF 2.0, or are you anticipating more support from the Fed that boosts some of the credit positioning?
Well, it's a really good question. I mean, I would say to you that we're fundamentalists by nature, and you have to factor in what the Fed is doing. I would say it's the former, not the latter. We're looking at exactly what the Fed said it's going to do. We're looking at the original deployment, which is $2 trillion, as I originally mentioned. There's another $2 trillion coming. You and I both know that they signed up for $2.3 trillion in a lending facility that was announced by Chairman Powell about a month ago. So on the Fed side of the stimulus, it's $6.3 trillion. And as I mentioned, on the fiscal side of the stimulus, if you factor in the sort of Larry Kudlow gearing on those COVID-19 recovery bonds, it's 6.7. So you just have to think about the magnitude of the stimulus. It's $13.7 trillion going into the economy. We know we've lost about $5.1 trillion in terms of lost economic output. But to me, that's not a bazooka, David. That is a green water wall of money. It's a green tsunami that's going to impact share prices. It's going to impact bond prices. And so, yes, we're in the middle of it right now. We're stuck in our homes. We're anxious about things. We see really bad unemployment data. But I'm really just encouraging people to see through that to the other side. There was a great book that one of my clients sent to me back in March. It was called The Great Influenza by John Berry. I would recommend that book to everybody on this call. I read it in over a weekend in 2 days. It reads like a thriller in terms of understanding what happened. Obviously, very tragic consequences. John Berry told David Rubenstein in an interview at the Library of Congress 2 weeks ago that he actually thinks that the number of deaths from the Spanish flu pandemic is closer to 60 to 80 million people, not the original estimate of 40 to 50 million. But we for sure lost 750,000 people in the US in 1918. And yet, no Federal Reserve stimulus. The end of World War I, going into 1919, 20, and 21, we touched off an age of consumerism, of pent-up demand by American consumers that led to the Roaring '20s and one of the peak years in U.S. economic history, which was 1923. And I just want to draw this comparison quickly. You know, we were building highways there. Now we have sort of the superhighway of the gigabit transmissions that are taking place as we move to the 5G platform. We were building automobiles. Now we're thinking about things in aerospace and thinking about things in communication technology. So there's another big wave of technology about to hit the earth that will lead to a tremendous amount of economic abundance after this is over. And in 1918, no Fed stimulus, we rocketed in there for a decade. And so I predict a lot of those things will happen, but we have to stay patient and we have to be disciplined and hold on to our assets through this crisis.
And as an incorrigible supply sider, I would point out that 1920s, roaring 20s environment, not only strong consumer pent-up demand, but incredible capital spending, businesses investing in the growth of the American economy. Well,
let me just add to that. You're going to get a lot of help from the government. Remember, distressed companies. This is the only distress cycle in my living memory, and I've been through 5 of them, where distressed companies are going to be able to draw from the federal government for help in recovery. Unlike the 2008 crisis, David, there's no villain here. You know, we were the villains, you and I and Wall Street in 2008. It slowed down a lot of the policy decisions. You know, we both read Firefighting by Geithner and Paulson and Ben Bernanke. What did Bernanke say in the book? You know, we were slowed down by politicians that wanted to punish bankers. And the death of Lehman Brothers, while it had the satisfaction of punishing some bankers for taking risk, it added 5 points to U.S. unemployment. And what those guys said at the end of that book, and that was written in 2018 at the 10th anniversary of the global financial crisis, they said we have to move faster. We have to be more aggressive when we get into these situations. And I think Jerome Powell and Secretary Mnuchin, Chairman Powell and Secretary Mnuchin have done that.
Yeah. Well, in terms of the market environment now, Anthony, we know of the COVID tensions and we know of the uncertainty that exists around post-COVID recovery, but that uncertainty seems to be a matter of the shape of recovery, not whether or not there's going to be one. So people can make an argument for a U shape, a V shape, somewhere in between. I'm starting to talk to clients a lot about the idea that it will be a different shape across different sectors, that it won't just be one shape to the whole economy, but we're going to have sort of different manifestations and different attributes of GDP and sectors. Is your view that SkyBridge's sort of expanded positioning right now is all weather and is capable of dealing with a whole host of outcomes?
Yeah, no question. Obviously, more macro exposure there, more directional exposure that can get to flat quickly in places like 0.72. Yeah. But you know what I would say about your analysis, I think it's very prescient. I think it's likely to be the case. But if you step back and look at the weighted average, I see it as an intermediate letter between a V and a U. I see the first or second quarter prints looking pretty much like 2019, which was robust economic activity. Remember, this was a recession not born from the typical supply-demand imbalances, the typical cyclicality of recession. This was born from a full-blown work stoppage. You mentioned a national margin call, but think about this as like a national disaster. It's almost like a super hurricane. It swept over all 50 states, and it caused us to have a full-blown work stoppage like you do in some of those FEMA areas. But the good news is our houses are intact. The water grid is available. The electrical grid is there. Our banks are in pretty good shape. And we're going to be coming out of our houses and re-entering the economy with this mega stimulus coming from the Federal Reserve and from the Treasury. So I do think it
is the issue of the bank. I'm sorry to interrupt. Is the issue of the banks not a really underrated issue right now? That not only are they not demonized and villainized right now the way they were 11 years ago, but they're in such a better financial position that as loan demand picks up, they have the balance sheets to go extend credit into the economy. I don't feel like that's being talked about, and yet it has a huge lever on growth going forward.
Well, I certainly think it does. And let me play devil's advocate for one moment. Just say, well, the banks have had a harder time lending to small businesses without, tying up personal guarantees and things like that. But look at what's going on at the federal government level. The banks pushed out $870 billion of PPP for the federal government and the SBA over a 6-week period of time. As Chairman Powell pointed out yesterday, the U.S. military deploys about $715 billion over the course of a year. They got that done in about 6 to 8 weeks. So just think about the prowess, the technology, and that multiplier effect. So I totally agree with you there. And I think it's very important to emphasize the fact that there is no villain here. It allows the federal government to operate with a much wider footprint and more aggressively. Now, we can debate whether or not we'll have inflation. We can debate the size and scale of the deficits. And I'm certainly very happy to have that debate. We could probably spend 2 fireside chats on it. But just looking at the near term, and again, not looking at the world the way we think it should be or ought to be, but just looking at the near term, this is going to show up in asset prices. This is going to deeply impact positively the economy. And I think we need to recognize that for our clients, and we need to coach our clients. We need to get them in position to be ready to take advantage of that.
Well, let me finish with a final question before we go to Q&A to bring it back to SkyBridge, because I think the advisors on the call, even apart from macroeconomic look and even portfolio positioning, but bring it back to the in-house at SkyBridge, Anthony. Operationally, your infrastructure, is your business solid, intact, and ready for the different challenges and evolutions you have in front of you? How should people feel about the future of SkyBridge as an institution?
Okay, so let me just lay out all the facts. We've been together. People will recall we bought the Fund of Funds Series G and Legion from Citibank. That transaction closed July 1st of 2010. So Ray, myself, and Troy have been together the last 10 years. The co-chief investment officers of the fund, Ray and Troy, have been together for 15 years. I brought in last year a gentleman by the name of Brett Messing to be the president and chief operating officer. Brett put a lot of his own money up and bought shares from our outside shareholder Challenger. He is a Harvard Law School classmate of mine. We've known each other for 34 years. He's done a great job of helping us manage and guide the company. Our chief compliance people like Marie Noble, been with the company for 10 plus years, CFO, 11 or 12 years. And so for me, there's a lot of continuity in the employment inside of SkyBridge. And so I'm very proud of that. You know, we haven't let anybody go, thank God. Of course, we each took a little bit of a pay cut reduction because of where assets went, but we're totally prepared for where we are and where we're going and the vagaries of where we're going. You know, we had a $300 million redemption, which is slated for June 30th. Some people have rescinded those redemptions. I'm very happy about that. Of course, we'll open up the window again in July. If people want to redeem, we're going to let them out. I'll point out to everybody, we had a 35% redemption in 2008, kept the team intact, kept the portfolio structure intact, and the company. We've made money, a lot of money, frankly, since 2008. And so all of us are well capitalized, love what we do, like each other. And so no matter where the redemptions go, we're going to be in business. And remember, we're just going to take a vertical slice of that fund. So it's not going to impair anybody if people want to redeem. On the flip side, though, you know, I'm an offensive player. You know, I like throwing the ball, David. And so we are raising money. We raised money in April. We raised money in May. We're taking new tickets in right now for June. And so, you know, you and I both know that in the asset management business, there's a little bit of a leaky bucket. In times of crisis, there's a little bit bigger of a leak and a leaky bucket, but there's also money coming in on the top fairly regularly. So I'm very confident about the firm. I'm very confident about where we are. I like the firm's culture a lot. I like our compliance structure and our strictness around compliance. And, you know, frankly, we really benefited from the SALT conference, I might add, because we've been doing that conference. You've attended it. We did it in Abu Dhabi last year. That's how we got to meet Rachel. We did it in Singapore twice, Tokyo once, 10 times in Las Vegas. For certain, we're going to be doing that conference again. We just have to wait for the health people to tell us when. But let me tell you, that conference really benefited us because we now know the entire waterfront of the most legendary hedge fund managers in the world. And we also know how to identify and get to the niche managers. So I'm very, very excited about where we're going. And one other thing I'm excited about, David, is I'm not in politics. Okay, that 11-day fiasco for me, while it was very, very humbling, it's got me very centered on what I love doing. And I'm super excited to be in the seat at SkyBridge, not in love with the fact that we have a global pandemic, but we have the tools, the discipline, and the resources inside the firm to make sure that we are well positioned coming out of this for our clients.
Anthony, thank you for letting me be a part of the conversation. I think I'm turning it back over to Rachel now. She's going to moderate a little Q&A from some of the listeners. And certainly, I hope I speak for a good portion of the RIA community in wishing SkyBridge all the best as we all recover from this pandemic, across society in a lot of different categories. But in this context, economically, look forward to what lies ahead for you and your firm, my friend.
Well, listen, I appreciate you're the best. I appreciate you staying with us and seeing the same discipline, having the same investment philosophy. And I expect you and I are going to be doing a lot more business in the future, David. So I'm sending you a big virtual hug. And I'm also giving you a big shout out for the haircut. I know you snuck a haircut in there at some point. I could tell.
Civil disobedience, my friend.
Good for you.
Rachel, is this going back to you now?
It has indeed. And thank you, Anthony and David. That was an excellent discussion. We've had a number of questions coming in from the audience. We have some SkyBridge specific ones and some more general investing ones. So I'm going to start with the SkyBridge ones first. I like what SkyBridge is doing moving forward. Does Anthony think SkyBridge has made any mistakes, or were they just really unlucky? So maybe you could talk us through what some of those mistakes were.
Listen, I mean, you want to talk about luck. Life is unfair. It's like I tell my 5 children, life is certainly unfair, but you guys won the lottery, and so did I. Just the fact I was born in America. So when we talk about luck, I want to stipulate, if you're on this call and you have this technology to experience this call, we're all very lucky. So the fact that we quote unquote got unlucky in March, I take that to the vagaries of life, and I don't really see that as something. I'm not going to disclaim our accountability or the blame on us. What I would say to you, that the mistake that we made, and I'll be very candid about this, we needed more meteor strike insurance in our portfolio. I think we were overconfident in January, where we were looking at our portfolio. It was 80% in structured credit. We saw a non-pandemic U.S. economy growing at about 2.4%. We saw unemployment at, basically full employment for the society, and a result of which we thought we were going to click off an 8 to 9% return with very, very little volatility. And so if you had said to me that our risk models were going to pick up the notion that the United States economy would go from a 3.5% full employment number to 8 weeks later at 14, but on the U6 number, 22.6%, first of all, I would have thought you were smoking something. I wouldn't have necessarily bought into that. And so I'm to be blamed for that. And so I think what I would say to people, that we have filtered that mistake now into our management mix. We're not going to be too risk averse as a result of that either, though. We're going to look at the markets in the continuum of time over a 3 to 5 year period of time, study the intrinsics, study the fundamentals. By and large, those hits that we took, 30% of them were realized, but a good percentage of them were not. And I think we're going to make that money back in the not too distant future. But yeah, I've got a whole phone book of mistakes that I could recant. You guys don't have enough time for that. But I think what's important for you to know about our culture, we're willing to admit our mistakes. We're willing to embrace what is going on in the society right now. And we're willing to have the boldness to make strategic pivots into places where we know there's a tremendous amount of value. And I just want everybody to know on this call, this fireside chat, we are using all of the resources and all of the relationships at SkyBridge to benefit our clients. And you're going to see that manifest itself in the portfolio going forward.
Fantastic. No, and that transparency is something I've really noticed since I joined SkyBridge too. So we've had a couple of questions as well, which sort of bring up more the points you've just talked about, sort of credit versus equities and valuations. From Anonymous, we have, it looks like structured credit is a beta play. Doesn't make sense paying hedge fund fees. And on the macro side, where do you see the opportunity given that rates are at or close to zero?
Okay, let me handle the first piece. So structured credit right now looks like a beta play, but I actually don't see it as a beta play because it's really just an unlocking of the value. But I think the good news is if you're in SkyBridge, you're not paying hedge fund manager fees because we are well below our high water mark. And so there is a 25 to 30% move in our portfolio before anybody's going to see hedge fund fees. The second question, if you could repeat it, Rachel, I was focused on that first one.
Yeah, so on the macro
That sounded
side,
like an Australian. It didn't sound like a Kiwi, by the way. That sounded like more like a cynical Australian, but we'll leave it at that. Go ahead, Rachel.
they said on the macro side, where do you see the opportunity given that rates are at or close to zero?
Well, listen, there's a lot of things going on the macro side. Just think of what Ray Dalio was saying in his letters in terms of positioning. There's going to be a re-engineering of the currency footprint. There's pressure in the European common market and the euro. There's stuff that can be done in Latin America and in China. And there is another monetary super cycle that is taking place right now as a result of the pandemic. And so if you look at a guy like Ray Dalio and you examine what he did post-recovery or during the recovery of 2009 and 10, the performance was exceptional. He's been 40-year return, 10+% per annum, but in periods of recovery, he's doing, high 30s, mid 40% return. So yes, I do think there's still a lot of opportunity. I get the point though about macro, where the flattening of interest rates and the Fed and central bankers entering the market as gunslinging hedge fund managers is evaporating some of the macro opportunities. But you take a group that we had a macro exposure to in the month of March, that group was up 8%. And so to me, I think there's opportunity there. And again, on a relative basis, it'll be smaller for us. We'll have a couple $100 million in macro on a $4 billion portfolio.
Fabulous. We do have a lot of questions still to get through. I would like to ask another question related to RMBS and then a question to both of you just to close things off. We also have, is forbearance a hidden risk for RMBS where we might end up with a wall of defaults in 12 months' time?
Okay, so I want to take that one. So I don't see that as a risk. I think number one, the stuff that we own is of very high quality. It's in very good neighborhoods, high credit scores, good coverage from a loan to value basis. Imagine somebody with $1.5 million house and they've got $600,000 of equity in the house. They've taken out a $900,000 mortgage. They're a white collar person that hasn't been laid off and they can do their job at home until the pandemic ends. It's their primary house where he or she is raising their children. I see it very unlikely that you'll see defaults there. Moreover, I think you got word from the Federal Housing Authority about 4 weeks ago that they would pluck out of the agency-supported tranches, they would pluck out non-performing loans. They would effectively buy them. You also got word from the Federal Housing Association that as it relates to the mortgage servicing companies. Remember, when we put these structures together, the mortgage servicing companies take on the risk of meeting principal and interest payments. There was some concern about that. The mortgage task force came back. The Federal Housing Authority said, okay, listen, the mortgage servicing companies are on the hook for the first 4 months of principal and interest, but there will be a lending facility from FHA, which is effectively coming from the Fed, to allow people to meet those principal and interest payments. So I think you get the defaults, frankly, if our assessments about the crisis is wrong. If we are not able to go back to work, if there is a total or a 2/3 shutdown of the U.S. economy that lasts for 12 or 24 months, then I think what you're talking about is a possibility. I don't see that right now. I'll say something that I'm not supposed to say, but I think most people know this intuitively. Once this economy opens, this economy is staying open. It's a callous thing to say. I don't mean to not look upon the tragedy, the national, the international tragedy, the death that people have experienced in their families. But I'm telling you that the United States government is not going to be able to carry the U.S. economy shut down. It's one thing to inject $12 trillion of stimulus, which is 60% of our annual GDP, but it's another thing to allow the entire economy to stay closed for a 6 or 12-month period of time. I just don't see that happening. Unfortunately, we will accept some levels of casualties to get the economy reopened. So for those reasons, I see those as risks. We always have to analyze every single risk that comes up, but I see those as manageable risks and not quite high on the scale of probability.
Okay, fantastic. And I know that you did mention some of the Fed stimulus packages before. And for anyone listening on this call, we do have some summary documents that outlines the stimulus. So feel free to reach out if you do want to do any more research on this. Closing question, which might be one of the hardest to answer. I'm a 27-year-old recent law school grad and I'm debating certain career paths. I love the markets and I'm thinking about starting out in an FA development program. Do you think this kind of career path is a good idea given the evolution of the business and the state of the broader economy?
Okay, so I think that's for both of us, right? So I'll let David answer. I'll give his answer first and then I'll give mine.
Look, if somebody has a passion about delivering financial advice to people who need it, then this is the greatest career in the world. And there is nothing that is happening now or is ever going to happen that will take away the need to deliver financial advice and create financial solutions for people in need. Some of the particulars about that advice and about the delivery of that advice change and evolve over time. Anthony and I have both lived through tremendous evolutions in the financial products business and in the delivery of advice that I focus on in my private wealth firm. But for a 27-year-old, a 22-year-old, or a 47-year-old reinventing themselves, I know of no career that I think am more excited about than this one. And I do not believe for a second that any technological evolution or any other economic development is ever going to change the need for people to receive financial advice from those who care to deliver it with competence and skill.
Well, I think it's very well said. I guess the only thing I would add, having gone to law school, I only learned two things in law school. I graduated in 1989, 31 short years ago. And I can remember being at my graduation wearing that white band because of the Tiananmen Square fiasco that was happening in Beijing 31 short years ago. But the two things I learned in law school, and don't be offended if you're a lawyer, it's just personality types. Two things I learned: don't be a lawyer and avoid lawsuits. Those are the two things I've learned, and I've tried to live by that practice over the last 31 years. What I love about our business, and I think David would agree with me on this, is that if you love business, this is the business of understanding other businesses. This is where you are going to drill into pharmaceuticals and insurance and mortgages and macroeconomics and understanding of monetary policy and super cycles in US and global history. And if that sort of stuff fascinates you, there is no better time to be entering these markets as an FA than today. And so I'm super excited about the future. And so I'm giving you the green light.
Fabulous. So from my part, I'll hand over to you for any closing words. But from my side, this has been really enjoyable. So thank you both. And also thank you to the participants for all your engaging questions. And if we didn't get to any of them, please do just follow up with someone from the team. But David and Anthony, over to you to close.
Oh, I'll let David go first.
Well, I will make myself available if there are people who'd like to reach out on the advisor side that want to know more of our experience with SkyBridge. I think that you've seen Anthony's transparency here today, and this is something that's very authentic, very sincere. If anyone was standing there right now saying we've done nothing wrong, we're a victim of circumstances, you would have to factor that into your trust level. But you hear them accepting responsibility for things that they wish they could have done differently, but more importantly, focusing on what to do going forward. It's the same thing I think all of us that are in the RIA community have to do for clients, not being able to get overly obsessed on past decisions, but focus on what's the best thing going forward. That's all that I can ask of the asset managers and the various partners we have in both alternative and traditional asset management, is that we focus on the future. And personally, I'm very excited for what they're doing institutionally and from a portfolio standpoint. So again, feel free to reach out to me if you happen to have more questions. I'll send it back over to Anthony to close us out.
Well, I appreciate it. I do appreciate our partnership, David. You've been a great friend and a great business partner. So thank you. And I would encourage RIAs that are listening in to please reach out to us. I think it's an interesting story for you as you're building your independent boutiques to get access to some of the managers that we're capable of getting access to for yourselves and your clients. I think David knows this, but I'll say this in general. Yes, we are marketing a fund. I sort of view the RIA community or FAs as sort of the Mayo Clinic. You're giving a full analysis of somebody's financial health and giving them a prescription and a forward prognosis. And we would like to be one of those pharmaceutical companies where we have one pill that goes into the matrix of that. But what I could assure you about a relationship with SkyBridge, and we've done this for many different teams over the years, is that we're fully available for client meetings, client dinners, client lunches. We're available for elephant hunting. You know, I've gone on more elephant trips hunting big prospects with FAs or RIA teams than you could possibly imagine. And I'm not selling SkyBridge per se, but I'm selling the overall holistic opportunities that that potential prospect has with the team. And so I think David has learned this. Some of you on the call that are working with us, we think about this stuff very holistically. We're very long-term in our orientation. I think the best days for SkyBridge are ahead of us. I'm not just saying that. If I look at the portfolio right now, I'm super excited about where we're going, despite the pain that we've just experienced. And I would love to have you, if you're not with us now, I'd love to have you be with us. And if you are with us, I'd like to have you add to us. And so with that, I just want to say thank you for listening. And Rachel did a great job moderating. David, you did a great job bringing up all the questions. And we're reachable and very accessible. You can get to us anytime. Just call our main number.
All investments are subject to risk, including the possible loss of the money you invest. For more information about SkyBridge Multi-Advisor Hedge Fund Portfolios Series G and the SkyBridge G2 Fund, call 1-888-759-2730 to obtain a prospectus. Investment objectives, risks, charges, expenses, and other important information about a fund are contained in the prospectus. Read and consider it carefully before investing. This webcast is for educational purposes only. We recommend that you consult a professional advisor about your individual situation.